the concern or the question is how huge is going to be the breakout in the hospitality industry? No question of whether or if. So let me begin with the latest set of announcements or news around your company, which is your ambitious plan to expand your portfolio of big box or your large inventory hotels. Let's start by understanding that. What is the scale and what is the capex that you have in mind?
Hi, Tamana. Pleasure being back on the channel. Look, we've got roughly around 2,890 odd rooms which are operational right now. And we've got, as of now, 880 rooms that we're working on. In addition to that, the business development side of the business is very active, looking for opportunities to grow further. If you really look at our history, we've typically had very large hotels. The Hawaii Westin at Hawaii, for example, has a combo 773 rooms. The JW Marriott at the airport in Mumbai is 585 rooms. We've got Bangalore, which is close to 400, expanding to 520. And we've got Hyderabad, which in the two hotels combined together as a complex is 600 odd rooms. So we've done big hotels in the past, and we just believe economies of scale work for that. However, you can't do this in tier 2 and tier 3 cities. So, any big investments or big box hotels will largely come in the top 7, 8 cities in India for us. And at tier 2 and tier 3 cities, if we do invest in those, it'll be smaller box hotels in the range of about 150 to 200 rooms each. In terms of capex, typically a hotel room costs us between 1 and 1.5 crores. And at 80 rooms, that's roughly around 1,300 crores of capex. In addition to that, we've got a couple of office buildings under construction, taking our capex as of now to roughly around 2,000 crores to be spent over the next couple of years.
Okay, so what I find interesting, Mr. Sethi, because whenever you speak to anyone in the hospitality space right now, the focus or the next growth area is in fact tier 2, tier 3 cities, and your pockets of tourism, whether it's a Lakshadweep or an Ayodhya. From what I'm understanding, Chalet is sticking to your top metros and your big box formats. That is not somewhere where you're venturing.
No, it's not that we're not venturing there. I think majority of the investments will come in tier 1 cities. If you look at our stated strategy, we do have a leisure play as a part of the stated strategy. So we've always said that we'd like to get into Goa, we'd like to get into the Rajasthan region, we'd like to have resorts in the drivable distance from Mumbai and Delhi. So that part of the strategy continues. But put all of this together, and at the end of it, even if we were to get into leisure destinations, we don't see our leisure portfolio going beyond 20% of our total portfolio. So the majority of the strategy will be growth in large cities, large box hotels.
Okay. So you've earmarked about 2,000 crore rupees for capital expansion. That money is there right now. Any further plans for fundraising?
So it's well known that we've announced 2,000 crore, potential 2,000 crore fundraise or capital raise, but that's not going to be needed for the announced pipeline. That's going to be beyond that. So let me put it like this, our trigger for raising the extra capital is going to be opportunities for deploying that capital. We don't have them on the plate as yet, and as and when we see that, we will use timely capital raise to have the gunpowder dry for it.
Is a portion of it going to go towards minimizing debt as well?
Yes, it will go towards minimizing debt. But if you really look at our debt, Tamanna, today, our debt-EBITDA ratios are healthy and they get healthier. In fact, over the next couple of years, the debt does fall quite dramatically, given that the cash flows are very strong, EBITDA numbers are extremely strong, and we are growing the portfolio. So all of that together is going to pay down the debt in any case. Add to that capital raise, and that will help us further pay down the debt as and when required. I do want to highlight that a lot of the debt today is on account of capital work in progress. And therefore, those CapEx assets, as they fructify into operations, will yield EBITDA numbers, which will further support the debt numbers.
Okay. I just want to come back a bit to your mix, and you're, of course, heavily skewed towards the corporate business, traveler. Are you planning to change that towards leisure, and to what extent? You mentioned briefly Goa, Rajasthan, etc. But any concrete plans on that end that you can share?
So we did acquire the Duke's Retreat in Lonavala, which is drivable distance from Mumbai in March last year. And that's under major renovation and expansion as we speak. We do operate a small resort at Mud Island for the group, and that'll go in for some expansion in sometime in the future. But we are very aggressively looking for opportunities in the stated leisure destination that I spoke about. And we do ultimately, as I mentioned earlier, see 20% of the portfolio being leisure portfolio when we look at it, say, 3-4 years from now. I do want to highlight, it's not just the business traveler that we cater to today. A lot of our hotels are very popular hotels for the MICE and wedding segments. So those are big segments for us. And of course, the cruise segment is pretty large for some of our city hotels.
Okay, so MICE, cruise and wedding are also playing in. Let's talk a bit about the leasing side of it. So you're expecting about 4.5 to 5 million square feet of leasing. What kind of incremental growth are you pegging there?
No, we'll ultimately end up with 3.2 million square foot of office space totally in the Chalet portfolio. So it's not going to be 4 to 4.5 million square feet. We've currently got about 1 million odd square foot under operation, and roughly around 70% of that is leased out. The rest of it came in the very recent weeks, and it's under advanced leasing status. We do expect the 3.2 million square foot of office space to ultimately stabilize at about 90% plus occupancy rates. And the rates, of course, the rental rates will vary depending on Mumbai or Bangalore.
Okay, just let's wrap with an outlook from you, Mr. Sethi, because your domestic travel, of course, is booming, but your foreign inbound travel still has not picked up even to pre-COVID levels. Is that where you're seeing the next push coming in? And what are your ARRs outlooks coming in right now as you see, an economy developing?
So, Tamanna, you're right. The foreign tourist arrivals, or FTAs as they're called, haven't picked up pace as compared to pre-pandemic months. And we believe that's the headroom for growth. That's going to create some serious headroom coming October onwards. Occupancy is already very high, largely on the back of domestic business travel for us. But when I say domestic business travel, it includes a lot of the MNCs. So the large MNCs of the world, because they have large offices in India, and when they travel within India, they're counted as domestic travel. So I do want to highlight that part. In terms of outlook, I think we've got a bullish run ahead of us for the next 4 to 5 years at least, because that's the visible future. I'm unable to predict beyond that, and that's on the back of the arbitrage that we have between demand and supply today. I see that riding the wave for the next 4 to 5 years at least.